With world-class expertise and local insight, Dexus creates value not just for today, but long into tomorrow.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello, welcome to the COB this Friday. I'm Juliet Sarli. Apologies, we are coming online a little bit after the time we normally do. It is Friday here. We've been monitoring very closely what has been happening on the overall market today, and we have seen CBA rally, but the local market still set for a weekly fall. Let's have a quick look at where the CBO 200 is finishing up the session as we see a little bit of positivity come through into these markets. Up 0.6% there on the CBO 200. The ASX 200 today is closing higher by 0.6%, 8,239 points. All right, let's get to the thematics of the day. In what has been an interesting week, remember this time last week we were getting ready to head to the polls, but today, as I mentioned, some upside coming through from the lenders, particularly the biggest stock on the market, CBA, helping out some of the other weakness we've seen, particularly in the mining players. So saved somewhat by the banks. We also have that Domain deal, $3 billion, CoStar, the US company, paying for REA Group's main rival Domain. And we're counting down to the Geneva gathering after we heard some pretty positive breakthrough, I think they're calling it, in terms of the US-UK trade talks. So what happens next with the US and China? Let's have a quick look at those sectoral moves. I mentioned CBA having a good session that helped the overall market. CBA closing higher by 1.3%. Watching very closely as well what's happening in the REITs space today. Charter Hall up by about 0.6%. We'll flip that along. We don't really need to see both those stock boards, but we'll get into the miners now and have a quick look at how they fared. Rio Tinto down 1.6%. This is kind of surprising a little bit in terms of some of the momentum in miners, given that we also had China reporting those bumper exports ahead of trade talks. Data showing a slump though in exports to the US, but an increase to the rest of the world on the eve of these trade talks. Domain, as we mentioned, striking a binding deal with US property giant CoStar to sell all its remaining shares at $4.43, a 42% premium. Macquarie shares up 4.4%, posted a 5% rise in full year profit. ANZ under pressure though, Jefferies, cutting its price target there on a weak outlook. QBE Insurance reiterating its full year outlook despite all the weather events we've faced in the period. And GQG Partners saw investor flows decline somewhat in April, but shares still did well. We also heard from the likes of News Corp CEO Robert Thomson calling President Trump's agenda a, quote, economic slap in the face. All right, someone we would never want to slap in the face. Let's welcome to the COB Shane Oliver from AMP. Great to see you. Happy Friday to you, Shane. Let's talk about the Geneva gathering, these trade talks. And I like what you said, President Trump sort of just spinning the roulette wheel here as to who he's going to target next.
Well, that's right. Obviously, a week or so ago on the weekend, he spun the roulette wheel and decided he would target foreign-made films. And these often are films made by US studios in other countries, like those in Australia, which struck me as totally ridiculous because America has a massive surplus in terms of services, of which the film industry is part. And of course, American films, if you just think about it, dominate the global movie industry, particularly in Anglo countries and in Europe. So I don't really know what he's on about there, but in any case, that's what happened. We did get some good news, as you were saying in the intro there, regarding US-UK trade deal, if you call it that. I guess the good news is that there was some sectoral relief on the sectoral tariffs for the UK. I think the bad news, though, is that 10% was locked in, and it's looking like the new standard. It seems to me that it's going to be very hard for Australia to get that 10% tariff on our products going to the US removed. We might get some relief on steel and aluminium going to the US, but I don't think we can get much beyond that. To be honest with you, I'm a little bit surprised that the UK signed up to this deal because they will end up worse off. They're letting more goods into the UK, particularly agriculture, industrial products, having to buy more Boeing planes, $10 billion worth of Boeing planes, and yet they're going to be far worse off than they were pre-Liberation Day. with that 10% tariff still applying to most of the goods that they send to the US. So I don't think it's a particularly good deal. It was probably a deal that America could do quite easily because they actually have a goods trade surplus with the UK. Other countries, I think, are going to be a lot more difficult going forward. And obviously, we'll see what happens on the weekend in regards to China.
Well, absolutely, and then what that means as well for overall markets. And there's still a lot of uncertainty out there, isn't there, Shane?
There certainly is. I mean, an optimistic take might be that the rest of the world ends up with a 10% tariff levied on it. They don't get the reciprocal tariffs that we talk about on 2nd of April. And China goes back to, say, 54%, which was the 2nd April number. So the 20% on fentanyl, the 34%, which is in the those tablets that Trump brought down from Mount Stupidity on 2nd of April. And announces everybody's new tariff, 34% on China, plus the 20% gives you the 54%. So maybe we go back to that in relation to China and everyone breathes a sigh of relief, but that's still a terrible outcome in terms of global trade. If you average it out, weighted average would mean an average effective tariff going into the US of 17 or 18%. Compared to 3%, 2.5%, 3% at the end of last year. So a massive increase in tariffs going into the US. Maybe not bad, it's quite as bad as feared in early April, but still a pretty big blow to the global economy and to global trade.
Absolutely. All right, I know we've got a few of your charts. We do have a few tech issues, so bear with us if these don't come up. But in terms of what we're seeing with implied market prices and overall interest rates, it's really quite extraordinary to see where we're at compared to the likes of Europe, UK, US. And we might
the UK and the US. So that's obviously a bit of a drag for Australia, but I think we will see more rate cuts. So we're the green line there, Australia. We're kind of around where the US is, or just a bit below where the US is at present. The US locked in there at 4.25 to 4.5. We're at 4.1%. UK did cut overnight to 4.25. At the other end, of course, you've got Europe and Canada, which have much lower rates. Now, the markets and those dots on the chart there, that's the market implied pricing, they're telling us that there's more cuts ahead. And I think that's what we'll see. I think the RBA is on track for a cut at the May meeting in a couple of weeks' time. I think there'll probably be another one in August, possibly another one in November, not sure on that one, but certainly another one by February, taking us down to the low threes in terms of the cash rate. And the money market is not that different to that, although the money market, I think, expects 4 rate cuts in Australia by year end. But we did see in the last week in Australia, we got those low inflation numbers a week ago for the trim mean, not as low as economists were looking at, but still going down in line with the RBA forecasts. And then we had in the last week household spending numbers showing that household spending volumes were flat in the March quarter. So the hopeful recovery in consumer spending seems to have stopped beyond a bit of a pickup in the December quarter. And it looks like consumers are still struggling, still very much dependent on sales activity, like, of course, the called Black Friday sales that we saw in November. I forgot the name of that US term. And of course, I think consumers still need more rate cuts if we're going to see this consumer recovery continue further. So that's the bottom line to all of this. And on the US, I think the US will start cutting, but probably not again till the September quarter, given what Powell said in the last week, despite the fact that Trump called him a fool and then proceeded to say that he likes the guy. After, it's always a bit hard to know where Trump's coming from, but anyway, it gives us a bit of a laugh.
It does. Yeah, Black Friday sales. I think you and I are old enough to remember when Boxing Day sales used to be the main event of the year, weren't they? All right, let's talk then, because you talked about how our economy is faring. We've got the employment data coming up in the next week.
That's right, and these numbers have been a bit confused lately, particularly a couple of months ago, and it seemed like everyone of my age had suddenly decided to retire at once, which distorted the numbers, pulled down employment and pulled down unemployment, I think it was, so distorted the numbers totally. The figures that came out for March didn't really clear the picture up, so we'll get another update with the April numbers coming out. The consensus is for something like a 20,000 gain in employment. Our view is a 25,000 gain. We think we'll probably see unemployment go back to 4.2%. So if you're sort of watching the RBA and how they would assess it, they would probably say the jobs numbers are neutral, unemployment is still low, much like it is in the US, so no need to rush. Flip side, though, is unlike the US, we are seeing a continued downtrend in underlying inflation, and we're seeing softness in consumer spending. And you can see the market expectations there for the upcoming RBA meetings. May is stuck around one cut, that's 1.25% cut. And by the end of the year, the market's looking for 4 cuts. And of course, the market did get very excited back in early April when that number had gone up to the market factoring in around 5 cuts by the end of the year, at least 5.25% cuts. I think some in the market were expecting we might get a 0.5% cut in May. As it's turned out, things haven't been as bad as feared. Back in early April, Trump did pivot, but he's still going to impose a big impost on the global economy, which will slow things down. And that's why I think the market's still going for 4 cuts.
And Shane, finally, I mean, a week ago we were heading to the polls. I had a great chat with some people from Magenta Advisory, earlier today about their take on the election. I know that you're an economist, not a political commentator, but it was over so quickly. I guess what's the takeaway for the economy now with 3 more years of Labor and the likelihood that potentially the opposition won't get in next election either, given so many divisions it seems to be in there and the fact we don't have a leader yet of that party?
Well, it was quite an interesting outcome. If you go back 6 months ago, it looked like that, Albo would go the same way as other incumbent governments around the world, or might go the same way, like it happened with the Democrats in the US and the UK, getting blamed for the cost of living issues. And then, of course, I think several things happened, but Trump came along and scared everybody that if we do change horses and go with a more right-wing government, we might end up with something like Trump, and that's causing chaos. We don't want that. Same thing happened in Canada. That similar reversal occurred going into their poll, and the Liberals were returned in Canada with Mark Carney, and in Australia we saw Labor return. But I think what happened, though, was that Labor, there's been lots of commentary on this, I think Labor clearly ran a better campaign. I kind of think of the Liberals as low tax, less government involvement in the economy, whereas that message wasn't clear in the election campaign. They were actually campaigning on higher taxes than Labor was, and more involvement in the economy. If you're going to nationalise power production with nuclear energy run by the government, that's a nationalisation, which to me is a bit of a step backwards in some ways. But so that, I think, confused everybody. And then there was this scare campaign, around, work from home started it off. And then, of course, other comparisons to Trump. Going forward, bottom line is I think it's more of the same, to be honest with you. The policies which were out there starting in January, most of them were reflected in the March budget. Those policies since then, the government says are going to be funded by less use of consultants and other things. So I don't think it changes the budget outlook. The outlook for immigration still remains for one of a slowing, but at higher numbers than the coalition was talking about, and all the stuff on Medicare and what have you was going to happen under both sides of politics anyway. So it's not really a big change in the great scheme of things. I do think we need a strong opposition, and that was the problem with this poll, that coalition didn't really express its fundamental views properly, consistent with its philosophy, which is individual reliance, less government, and lower taxes. I mean, they really need to go back to that, but without going too far right wing. And without sounding anything like Trump, because Australians are clearly rejecting that US Trump style model in this context. But yeah, odds are it looks like we're going to have Labor for a couple of terms now, a couple of extra terms. So this gap in between the seats that the Labor has, I think 90 at the latest count, and the coalition is the widest it's been since the 1970s. And it will take a while for the coalition to reverse that. Inevitably, it will change, and that's just the way politics works. Hubris will set in on the Labor side. There'll be some things go wrong, and then coalition will get its act back together, and we'll see a swing again. But that's probably many years away from now before we get to that point.
Yeah, absolutely. All right, Shane, always a pleasure. Have a fabulous weekend. Thank you so much. Shane Oliver is, of course, thank you, the Chief Economist there from AMP. Getting back to the equity market, the stock of the day, REA Group, it reported an 18% rise in revenue, but of course we're really focusing in on REA Group on the back of that CoStar bid for its rival Domain. Luke Winchester from Merewether Capital, Richard Hemming from Under the Radar Report joined Andrew on the call.
REA is expensive by any measure, and it's more expensive than the price that Domain was taken out. Like REA is trading on 60, 65 times PE. Domain is taken out around 40, 45 times. REA is about 10 times the size, and it has impressive operating margins at around 55, 60%. So I just think, for me, it's just, I wouldn't be buying it.
Trades on 50-ish times earnings, which is quite high. I wouldn't sell either though, Andrew, and the reason why is if you've been there for a while in particular, you might be sitting on a nice capital gain, you're not looking to lock that in, but this is a business that probably more than a few of the others that trade on those lofty valuations, I trust this at some point will earn its way into its valuation. Now that might be 5-10 years away, but I have no doubt it can do it just because it's so structurally entrenched in that market. I know you're talking about Domain and CoStar. They'll try and nip at the heels, but I think that gap's just too big now.
All right, we're at the end of the trading week. Let's have a look at the leaders in today's session. Liontown Resources, up an impressive 17%. I feel like I need to find out if there was any news on Liontown. I'm seeing a couple of broker upgrades, but don't see that one just right there. But anyway, we'll find out what was behind that. Nuix up by more than 10%. Nine Entertainment, of course, getting about $1.4 billion from CoStar buying into Domain. Super Retail also had a great session. Mike McCarthy from Moomoo's got a good call on Super Retail. You can find that online. Let's have a look at the laggards in today's session. Smart Group down by about 6%. Light & Wonder, remember, came through with a trading update yesterday. A couple of broker downgrades today. When we look at the small end of the town and the leaders there in today's session, Doug Tech up by 9.4%. Webjet, interestingly, up by 9.4%. Stuart Roberts from Stocks Down Under, he's staying away from travel at the moment, particularly given all these stories of people being turned away from the US on travel. And let's have a look at the laggards in the small end of town. Avita Medical, it did come through with an update today, so the market didn't like that one. Avita reaffirming, though, expectations for a 55 to 65% jump in full year commercial revenue. Tonight, we have quite a lot of Fed speakers actually out tonight. Bank of England Governor Bailey, of course, speaking as well after their rate cut decision, but the FOMC members, we've got the likes of Barr, Kugler, Williams, all speaking tonight. Tomorrow's Saturday, next week. We have Tuesday, the CBA household spending indicator. We've also got US CPI and PPI out next week. The unemployment rate, of course, for April, I was just talking about that with Shane Oliver, and US retail sales among some of the data. Worth noting, you've also got the likes of Japan, the UK coming through with their first quarter GDP. A positive end to the trading week. The CBO 200 there up by 0.6% on the close. But when we look at the overall weekly move on the ASX 200, pretty flat. In fact, it looks like we've gone nowhere from last Friday. But we did have a positive session today, up 0.5%, 8,231 points. All right, that does it for AusBiz for this week. We'll be back, of course, bright and early on Monday. Have a safe and fabulous weekend. We'll see you then.